In this video, we're going to talk about swings, which in reality is the market's natural form. Now, I don't know if you remember, but earlier on in one of the previous videos, we talked about the fact that we're trend followers and we like swing trading. And the reason that we like swing trading is that we understand that the markets never just go from A to B without stopping at C, D, E, and F in the meantime. So we understand that the markets are never just going to go in one direction without giving us pullbacks. And this kind of gives us a nice feeling because we know that whereas there are some traders who want to be in the moves very, very early and they end up getting stopped out because they're trying to trade the breakouts, we understand that we can wait for the breakout to occur and then we can wait for a pullback to come to a predefined level, which we'll talk to you about later, where we can then take our trade, which gives us a lower risk trade because first of all, we understand that the breakout has already taken place. And secondly, we're trading it at a predefined level. Okay, so in this video here, we're going to talk to you about what a swing looks like in the market and also how you can go about trading them. So as I just said, the market's natural form is to swing in the direction of a trend. Now, yes, there are going to be periods of consolidations, but even within those periods of consolidation, you also see swings in the market. Now, us as trend traders, we're not as interested in the consolidating periods. We're more interested in the trending periods, but it's nice to know that they exist all the same. Okay, so what we're looking to do is we're looking to trade the price when it breaks out with momentum. We're looking to trade the pullbacks to predefined levels of support and resistance. And as I said earlier, this gives us a higher probability of success. So first of all, at the fundamentals of everything, we have to believe that the price will not just trade in one direction. It's never, ever, ever going to go from A to B without giving a pullback. And once it's given a little bit of a pullback, we need to understand a few things. First of all, that this is profit taking that's going on for a lot of it. So ultimately, whereas a lot of traders will sit there and think, oh, the markets are now turning, now we need to be looking to go in the opposite direction. Actually, we're sat there rubbing our hands thinking, well, this is profit taking. And all of those market participants that were in on that previous move are going to want to make some money again. And the highest probability trade is going to be in the direction of the previous move, okay, which is where the big money was. If all the big money managed to push the price in a direction with momentum, then we get a little bit of a pullback. Now, not too much of a pullback. Okay, if we get 100% of the swing, then maybe we're not as interested in the opportunity as maybe if we got 50% of a retracement. But in any case, when we get the pullback, as long as it's an orderly pullback, which we'll show you on the charts in a few minutes, then we'd be looking to get into a trade in the direction of the trend, which is where the big money just made all of its profits. Okay, because if you think about this from a psychological perspective, if you're a big hedge fund and you've just taken a trade and you've made a lot of money in a trade and you want to take some profits, when the market then comes back to a cheaper price. So let's say, for example, we're in an uptrend, okay? And there's been a massive hedge funds just made a lot of money buying the market. The market now starts to pull back a little bit, which will be, yes, there will be some selling involved, but some of it will be profit taking. So all of those funds and banks and speculators that made all of that money on the way up, they're now saying, you know what, let's book some profits because we've made a huge chunk of money just now and wait for a better price to enter. The market then starts to drop back a little bit. And when it drops back, the participants that just made all of that money, they're now thinking to themselves, well, actually, you know what? We just made all of that money buying it, a couple of days ago or a few weeks ago. Now the market's come back to a predefined level of support or resistance. So they know that the rest of the markets are going to be looking at this particular trade. They've just made money on the way up. Why not give it another go? Because at the very least, for the most part, the markets are at least going to go and test the highs again that they just came from. So there's some room there for them to be able to make a little bit of profit before they need to think again about maybe profit taking or adding some more money when it gets to the breakout point. Okay, so we need to know, we need to understand fundamentally that price does not just trade in one direction, and every trend has pullbacks, and these pullbacks for the most part are going to be a good deal of profit taking and not the reverse of the market. So let's say that we're in that uptrend, it's going to be profit taking, i.e. buyers, and to take profit from a buy position, obviously they need to sell. And with that selling, that causes the market to drop a little bit. And conversely, if you were in a downtrend and a lot of sellers have been in control, for the sellers to take some profit, they need to get people to buy their positions back off of them. Okay, so that's what we're talking about when we say profit taking. Now, when it comes to trading swings in the market, we will get into more of the rules later on, but a few of the fundamental principles that you need to understand is that you always look to trade from the most obvious levels. Us as traders, we're looking to ride on the coattails of the bigger boys, okay, as retail traders, because ultimately we don't have enough capital ever to move the market, certainly not in the Forex markets. So what we're trying to do instead is we're trying to figure out where the bigger boys are going to position themselves and then jump in on that trade and let their money take us to our profit targets. Does that make sense to you guys? So we're always looking for the most obvious levels to trade from. The swing points, which I'll show you what they are in just a second, they can be used for a couple of things. First of all, they can be used for stop placement. So if you want to place your stop loss, ideally what we usually do is we place it behind the swing point. If you're going to use the swing points for take profits, then what you look to do is ultimately take some of your position off the table before you get to that swing point. So what you're ultimately saying is that the market doesn't need to do anything fantastic for you to be able to make a little bit of profit. Now, when I say anything fantastic, what I actually mean is it doesn't need to break out to a new high or a new low or anything like that. All it needs to do is attempt to get back to where it just came from. Now, we know the market can get there because it just proved it to us. That's where the market started to take profit. So when we get involved at the support or the resistance level, we're looking to trade it just up towards the next swing point, which is where, if there is going to be any of a turnaround, that would be a logical place to do it. Now, if you're looking to ride the bigger move, which sometimes we're looking to do, then what you can do instead is you take some partial profits. So maybe you take half of your position off the table and you leave the other half to ride. But when it comes to the rules of the systems and this kind of stuff, we'll talk a lot more about it. Okay, so in the videos to come in the next couple of hours, we will talk about profit taking and stop placements and all of that kind of good stuff. Okay, but right now I just want you to understand how you can use swing points to help with your trading. So first of all, we're looking for the most obvious levels to trade from. We understand that the pullbacks are the market's natural form. It's just what happens. The market never goes from A to B without stopping at C and D in the meantime. And as I said, you can use them for stop placements or profit targets. So what do swings look like? Well, ultimately, for the most part, we can only really tell with any real certainty that a swing is in place after the fact, unfortunately. Yes, we can predict them to a point because we have previous levels of support and resistance, so we look at where the market may turn around, but ultimately you can only fundamentally say it with any conviction after the fact. But that doesn't stop us trading in any case, okay? Because we understand that trading isn't a 100% business. Trading is basically being like a casino. It's having an edge and it's allowing your edge to play out. And that's what we're doing here. So we understand the market doesn't go in one position. It doesn't just go from A to B. So as you can see here, we've got a little bit of an up move followed by a little bit of a retracement. Now this retracement here is profit taking. So all of those bulls, for those green candles that you can see there, all of the buyers in the market then are now taking a little bit of profit. So that then translates into our swing high. So when you hear me talk about a swing high or a swing low, the swing high would be a high. Okay, so that's where the market has gone up to and then it's turned around. It's found a sort of a ceiling and it's bounced off of it. The market then makes an attempt to go higher and that then forms for us a swing low. The market then turns around, a little bit of profit taking. That then forms our swing high. And then finally, it then makes another move in the direction of the trend, which then forms our swing low. Okay, now I know this is a theory of it, and we will get into some live charts in a second. But what I want you to understand is that when we're talking about swing highs and swing lows, we're talking about the big moves. Okay, we're not talking about, you know, zooming into your chart so much that you can only see one or two candles. We're looking at the overall move of the market, and that's how we judge a swing high or a swing low. And this is what it looks like on a real chart. Now we'll go to some live charts in a second, but this is just to give you an example so that we can highlight it very well. As you can see, if I just get the mouse to hover over here, we're not looking at these little bits here. we're looking at the major move, the big move, the move that comes up here. That would then form our swing high. The market then comes down, finds a bottom, and then rallies from there. That forms our swing low. The market then comes up to a point, reverses, and forms our swing high. So notice that when we're saying swing high, we're not talking about this point here or this point here. We're talking about where the market actually reverses. So you kind of see the market swinging up and down and up and down and swinging up and down. Now, I said to you before that you can only really tell it after the fact, which is true. But you can sort of project where you feel that the market will turn around. So for example, looking at this particular trade here, this trade was actually quite an easy one to take because the market had pulled back to a previous level of demand here where buyers got involved before. You see these big momentum candles here? We can see that there was a lot of buying pressure in here. So when the market pulls back to that level, we can anticipate a similar sort of move. And look at what happens. Big buying demand gets involved again. Okay, so then that then goes up here, forms our swing high, pulls back, forms a swing low. Now, if we cast our minds to the left, taking a look here, what is that? That's our previous level of resistance, our previous swing high, which is now acting as support. So that's how we can project that this price move here to the upside is going to occur by looking left on the charts and looking where the price previously reacted with a particular level. Okay, so then that makes our swing low, swing high, swing low. Okay, so in a nutshell, there isn't anything in this video here with regards to trading rules as such. What we're trying to do is get you acclimatized to what a chart looks like. This is the sort of zoom that you want to have on your charts. Oftentimes I get students send us emails and they're just zoomed way too far into their charts and it just doesn't make any sense whatsoever because ultimately they've maybe got just literally this little swing here zoomed in on their chart. So they can't see the rest of the market here. Whereas when you zoom out a little bit here, you can see the swings in the market. So even though we've got this particular move coming against us here, we have confidence that that's then going to turn into another swing to the upside because we look left and we say, well, there's momentum there, there's momentum here. What do we expect to happen at the end of this move? We expect some buying to come involved because we know that the market's never going to go from there all the way down to there without stopping in between. Even if this was a bit of a trend change, the market would still make some sort of an attempt at these highs before crashing back below this swing low and moving lower. So I hope that makes sense to you guys. If you've got any questions whatsoever, please feel free to post it in the video below. Otherwise, I look forward to seeing you on the next video. Thank you very much for watching and take care.